course, it's midweek, and we've got Brent crude oil trading a little bit down this morning at about 0.5%, 82.31. Adi Imsirovic, Director, Surrey Clean Energy and Senior Associates at CSIS. Adi, is this a kind of a, the ceiling, or is this the floor of this market? I asked that question a few times in recent weeks because we sort of went up the mountain to 90, but we came right back down to the low 80s where we sort of seemed most comfortable so far this year. So is this the floor or the ceiling on this oil market?
Good morning, Sean. I think it's neither. I think it's somewhere about $85 is somewhere sort of a middle. I am actually a little bit surprised. I expected oil market to be around $90. Still, I think Q3, 4, I think we'll have a pickup in demand because we always expect the second half of the year to be a lot stronger than the first half. So I still think we'll probably, by the end of the year, easily see $90. For now, there's been just quite a few surprises. I think we've seen production from the Americas, extremely good. We've got Canada now exporting, I think, one of these days, literally their first cargo from Vancouver going into China. That will support the values of Canadian crude. And as it does so, it will also increase investment. Already, some Canadian producers are going bullish and talking about additional investments in their production. So, we're sitting at the same time, you see UAE, they're sitting on massive excess capacity. You've got Saudi Arabia on massive excess capacity. Between the two of them, they've got about 6 million barrels of excess capacity. So it's really, really hard to get super bullish. There should be demand coming in. China's been very disappointing. The Chinese imports, there's been a flood of actually exports of products from China, and that's impacted the whole world, literally, in terms of refinery margins. One of the main reasons why we're seeing gas oil cracks where they are right now is partly to do with Chinese exports. So, overall, situation is it's been very hard to predict, actually, to be fair, because we haven't been here before. I just mentioned before we started, we were having a chat. We had COVID, then we had that bounce back, and after that big rebound, where do we go? And now we're stabilizing somewhere, and everyone is looking for that equilibrium, which seems to be about 1.5 million barrels growth. Which is not much, really, can be met from the Americas quite easily.
Vandana Hari, founder and CEO of Vanda Insights. Vanda, this week at the MPGC here in Dubai, the S&P Global Commodity Insights event, and they're forecasting similar numbers that Adi just mentioned there, demand growth of 1.5 or give or take for the year, and giving 75% of it, which I thought was the interesting data point heard this week here, 75% of that incremental demand growth coming from Asia. Your thoughts on that number, 75% of whatever the total number is, that Asia still represents such a significant part of that marginal growth, and is it indeed still delivering that?
Yeah, interesting. Morning, Sean. So 75% of the growth coming from Asia, I wouldn't dispute that, because let's face it, where else is growth going to come from? I mean, look at US data, and I have been looking quite rather closely since last year, in terms of like what is the post-COVID recovery looking like in US, and you look in Europe. And both those places at best are stagnant, so in terms of oil consumption, or even trending lower year on year. And certainly both those regions are way below their 2019 levels, right? So growth is going to come from Asia. But when you sort of then zoom into Asia, it's China and India. So then the question really is, what is the total number of which you're saying 75% comes from Asia? So if you say, like, for instance, 1.2 million barrels per day year-on-year growth, then you say, okay, 75% of that, let's say 800,000, 900,000 barrel comes from Asia. I would be willing to go with that. So, let's say China contributes 300,000, 400,000 barrels per day, perhaps India another 300,000 barrels per day.
You're
And the little
talking
bit you
about this
get from
year.
this year, yes.
Yeah.
But if you're saying that, like OPEC is saying that 2.25 million barrels per day year on year, and then you really start to question who's going to contribute to this kind of growth, right? And certainly 75% of that, Asia is not capable of adding that much. Were you talking about another time frame rather than this year?
No, this year. This is
Yeah.
they're forecasting actually that next year it would jump up to close to 80%. That was what was broadcast from the stage here at
Yeah.
MPGC yesterday.
So that goes absolutely without saying, Sean. So yes, China and India, but then again, I think it's worth bearing in mind that China is not growing at the kind of pace it was until before COVID. And India is growing at a very healthy pace, 5.5%, even perhaps 6% year-on-year growth, but that's on a baseline of 5 million barrels per day. So at the most you get like 350,000 barrels per day year-on-year. So yes, if it's like 1.5 million barrels per day and 75% coming from Asia, I would go with that. But really, anything more than that, I have my doubts. Where is that kind of growth going to come from?
Gaurav Sharma, journalist and energy analyst. Gaurav, there's been a certain amount of debate here at the MPGC this week about what influence there's still on the markets here by the will Fed or won't the Fed cut interest rates. It's sort of an ongoing bounce back and forward in recent weeks and months. Your thoughts on that to continue to be an influence for the energy markets as we go towards the second half of the year?
Morning, Sean. Great to be back in the program. I think one thing I would say here is there is definitely a connect. I would not say an absolute connect. Now, how you look at this is that the sort of lackluster pricing that we've seen, if I may call it that we've seen over the last 2-3 weeks, the calm, if I may say so, the month of May. What has happened is that we're trying to take a steer on where inflation goes. The IMF said the other day, the Bank of England, Fed, they all seem to have room to cut interest rates in the second half of the year. Now, should they go down that pathway as is expected, the consumer is going to feel a little bit more confident in terms of their spend, and that will then have a domino effect on oil. It's not just about driving, haulage and a whole lot of other supply chains are reliant on that. So I think OPEC is definitely counting on it. The second half of the year, there's likely to be an uptick in demand. The question is how the remainder of May and the next month going to pan out. I think we'll probably keep bouncing within this sort of range-bound atmosphere that we have between 80 and 85 bucks. The key thing to note is that at one point in time, not sort of a good, say maybe even a few weeks ago, we were talking about 85 providing the floor. Now that's kind of become the ceiling. But yes, I agree with Addy. It's not going to last pretty long. You might see the 90s. Now, one thing is worth noting, as one also said, is that if you look at where the direction of travel from here, and both both the key main protagonists here are the IEA and OPEC, and they'll give you divergent demand figures. If we go somewhere in the modest middle, as Addy was saying, take an average of that, even that can still be serviced, I beg your pardon, by US production alone. So there's a lot of light crude in the market. So the price would go up, but it's unlikely to overshoot to this sort of $100 dream that a lot of people have, that especially the bulls have.
Yeah, I think they might be giving up on that a bit. I mean, Addy, your thoughts on, from the point of view, just in your earlier comment with 6+ million barrels of idle capacity and even more, what keeps this market up in the low 80s? I mean, you would think that market with that amount of idle supply should be a weaker market, but yet there does seem to be resistance. I mean, through the year to date, 82 to 85, give or take, it has held there, although started the year at 75, but nonetheless, since it broke out of that early in the year, it's held there. What's keeping that elevated, even though we've got so much idle supply and relatively sort of agnostic demand growth?
Yeah. Before I answer directly your question, just want to add a little bit from Gaurav was saying I think we've got a massive problem due to OPEC cuts. We've got a massive problem of basically a market gone off the keel, sort of being extremely uneven. We've got a massive supply of light sweet crudes, primarily US crude. Okay. So we've got to the point where I think 40s on average in the North Sea sits on a ship a couple of weeks before it gets sold. So we've got actually increased, volumes of oil on the water. Light grades like Saharan are collapsed. Some Nigerian grades have gone below dated Brent. Dated Brent, which is a measure of the physical light sweet crude, is actually well in contango at the front end or CFD market compared to the futures market. So it's extremely, extremely weak, but that's the weakness.
What does that communicate to you, those anomalies?
I was just about to say, what that means is basically that the light sweet barrels are way oversupplied. That the market now on the other side, heavy sours are actually in good demand. So Brent Dubai EFS is barely positive, which basically says that, Dubai swaps for the same month as futures. Okay, slightly different. Don't want to get technical there, but it's Asian market and medium sours are actually doing very well because that's where the OPEC cuts are coming from. At the same time, you've got a situation where UAE, for example, they've now finished this the project in Ruwais refinery. So now they're running a lot more. They want to export more Murban, which is sort of medium sweet crude, basically, and take more Upper Zakum, which actually people want in Asia, but they can't get it because Ruwais is now running up to 400,000 barrels a day. So there's a big...
It's releasing more Murban, basically, more sweet into the market.
There's a very uneven situation in the market that, and if you look at the sort of RBOB cracks, there's $26. I mean, they're not doing very well. So gasoline demand in the United States is actually stagnating, as I think Gaurav already said. It's not looking that great. Now, going back to your question, why are we at $80+? Well, I think it's for the same reason that the stock market is where it is. I think it's all about expectations. I think the expectation was of a hard landing, and then maybe not so hard landing at the moment. I think pretty much everyone expects macro situation to be fairly benign. We will eventually see those rate cuts, which is good for commodities. And that's all reflected in a sort of bullish outlook. You don't want to sell if the rates are going down. You don't want to sell anything. You want to sit on this stuff. So oil market is hanging in there, and let's not forget, it's always been a very good hedge against inflation. So in case the Fed sort of does become a little bit more dovish, it's always good to hold some commodities in your portfolio.
Vanda, it's a similar idea. I mean, given OPEC Plus are due to meet now next week, a big sort of meeting for the year, plans for supply in the second half. How do you think they approach that meeting? It looks right now as a no-brainer rollover. Anything you see there that might make it otherwise?
Yeah, Sean, they really don't have a choice. This is not the right time to unwind if they want to maintain prices, at least a floor at $80 Brent, right? Because all you need is an OPEC announcement, even let alone all the members ending. But even if Saudi Arabia were to say, because they are cutting more, right, a million barrels per day more, even if they were to say that, we're going to start bring this oil back into the market, you will see easily Brent start slipping towards 75. Because the important thing that is holding crude up the past several months, and especially through April, when it hit year-to-date highs of $91 Brent, was the geopolitical fear premium. That has now completely gone. So, so that really paints OPEC into a corner. Something that doesn't get talked about enough, but also important to bear in mind, I think, is also in the other direction. I don't think OPEC has any leeway to increase. I dare say they would probably want to cut a little bit more, again, in anticipation. And, they've been saying they'd rather be preemptive and preventative of a slide in prices. But who will cut? So, we already have just about half of the 19 members actually cutting output. And the others are not even meeting their new lowered quota. So all said and done, not really very little maneuvering room for OPEC. I personally think, Sean, that far more interesting is going to be what will happen in the weeks after the ministerial meeting of the 1st of June, because by end of June, they are going to review and revisit the baselines that will be used for 2025. And we've seen already in the past few weeks, we've heard rumblings from Iraq, we've heard from Kazakhstan. Both these countries are sort of straining at the leash. They have way more capacity than their baselines. They want to increase the capacity very quickly, before whatever the transition takes over and oil and gas demand goes down. So, that's where we left with OPEC. Not much change on June 1, but I think exciting weeks after that.
Gaurav, I mean, as Vanda mentions there, the idea that the geopolitical premium has been drawn out of this market, and maybe that's what we saw in early April when we reached that sort of 90 plus peak, and we've come off sort of dramatically $10 since then. But this is a market still looking over its shoulder at geopolitics. It might be out of the premium, but you wouldn't want to short this market given the geopolitical narratives around the world. Your thoughts on that this is the floor because you can't short from here given the risks that still exist?
Well, I suspect there are a few things there. One is if you look at the risk premium, it is always there, it always lurks around the market, but it has recalibrated. We aren't in a situation in terms of the supply dynamic. We're not in a situation where we were 10 years ago. This is not the sort of double-digit premium that you'll find. That's not to say that it has dissipated. At the same time, we had certain infractions last month, and even that didn't push price push the oil price to three figures, for the simple reason that it's existed in the background since October, tragically. And there is another issue. When the Israelis went hammer and tongs, no key infrastructure was hit. And there's certain thing about the Iranians shutting down the Strait of Hormuz. It's a lot of nonsense. They'll be shooting themselves in the foot first if they go down that pathway. So the risk premium is there. It's recalibrated. It's not what it used to be. Let's say around somewhere between 2010 and 2012, or sort of at the start of the last decade, as opposed to this one. Now, in terms of what is the direction of travel, it still remains a reasonably well-supplied market. Some very interesting arbitrage plays going on. We were talking about it before we went live off the west coast of Canada. So the arbitrage plays are there, the swings and roundabouts, but it still is a reasonably well-supplied market. And I can share some anecdotal evidence with you is that a number of physical traders, as of this moment when we speak, are sitting on their solver models, and they're not really having any sort of difficulty trying to get oil at the price point that they want it at. So that tells you a lot. I always look at what the physical guys are thinking to color your vision in terms of how you trade this commodity. So the physical guys appear to be a satisfied bunch. You may want to short here and there, play a week here and there, but not tremendously, because everybody seems to be in this happy harmony of saying, well, it's a well-supplied market and I'm getting what I need out of it.
Let's go to the survey question, which sort of dovetails on the end of that geopolitical question and this new issue that has emerged in the last few days. The decision by the International Criminal Court to seek arrest warrants for the Israeli Prime Minister, amongst others, but most notably the Israeli Prime Minister. And now we've got the U.S. government and the Israeli sort of alliance in Washington speaking out and indicating pretty strong action in backlash against this decision. So my question this morning is, how could the U.S.-led backlash against the ICC arrest bid for Israel's prime minister impact oil markets? I mean, you have to sort of see a few dots connecting here, but that we've already had the foreign minister of the United States saying last night that this could derail the peace talks in Gaza, things like that. So I'm wondering, does this have a domino knock-on effect? Looking for your thoughts, bullish, bearish, or no impact? Welcome your views on that. Adi, just picking up a little bit on Gaurav's thoughts there, another commentary through the few days here at the MPGC in Dubai was sadness on traders' faces because the volatility has gone away. And another person said, no, that's they're exhausted and they need a timeout because they've just been too busy making so much money. But nonetheless, that volatility. And then there was some commentary that, oh no, don't enjoy your rest because volatility is coming back in the second half. Your thoughts on that? Obviously, you are the ex-trader of us, the group this morning. The importance of volatility. Do you see it coming back in the second half of the year?
Right. Yes. Just a quick one, if you allow me, on volatility.
Please.
And how traders are making money. The usual misconception is that traders make money out of volatility. They do make money out of volatility. Somehow they pump the market, and sooner or later they make money, which is absolute nonsense. Trading is a business. If you look at big traders like Vitol, Glencore, Mercuria, and so on, they make money every year. They don't punt the market. They trade, which means they run a business that makes money. And trading is a business. If I can summarize what trading is about, is constructing a book where you're buying cheap volatility, okay, or optionality on volatility. Okay, so you're buying a lot of cheap optionality, and then when the volatility hits in, your book's in the money automatically because you're going to actually exercise that optionality at much higher prices. Okay, I don't know if that's clear enough. So
as mud, as they say.
Smart. Okay. Well, anyway, that's the idea behind trading. So,
but just generally, taking the narrative for your average punter, obviously the traders have made huge amounts of money in the last 2 years based on this general concept of volatility, which currently appears to have gone away or at least drifted to the sidelines. And the narrative here at MPGC this week is, hold on, it's coming back in the second half. Your thoughts on that basic narrative?
I think what
traders?
volatility is definitely coming back. It's the usual adagio, it sort of sell in May, go away. Essentially, people do look forward to some summer holidays. Kids go on holiday, and everyone else wants a break. As soon as we come back, we've got a US election, I think, which will provide plenty of volatility and unpredictability. So I think it's coming back. What I think is more important to point when you say traders, I would say this about oil traders, but oil trading will be important for the next 20 years, but it's really diminishing in importance for the trading companies. If you look at, and that's what the situation in Dubai is, everyone still, especially in the Middle East, everyone tends to talk about oil. Look, most of the traders, if you talk to Vitol, or Shell, Dasco, most of their money actually comes from either LNG trading or power trading. They make a lot of money on LNG, and LNG is providing a hell of a lot of volatility. You've got here, Euro TTF is back again over $10. Nobody expected that because the sort of winter heating season over. But demand came back from Asia. Korea started buying like crazy. I think Korean buying is up over 30%. The same pretty much in most Asian countries. That plus the volatility on the power prices or electricity prices has provided traders with a lot of other stuff. So you see some other trading companies, newer trading
So don't
companies.
feel sorry for them, is what you're saying.
Absolutely, yeah. Like
don't buy them a coffee on the sidelines.
Going a little bit more into metals. Metals have been extremely volatile lately. So yes, they've always find something. Don't you worry about traders.
I'm sure. I wanted, Wanda, to get your thoughts on, again, the second half of the year, and OPEC will be looking at this as we all do, where is China going? And there's been a number of headlines and reporting in recent days that China's trying to deal with this property issue, right? Trying to financial machinations. Even there was reported that the Chinese government might start buying redundant empty apartments and so forth like that. Your thoughts on China being able to tackle this real estate problem sufficiently so that extra bump in the Chinese economy and demand in the energy space does come in the second half of this year?
Yeah, indeed, it's been described as an unprecedented slew of stimulus measures for the property sector. To me personally, it reeks of desperation. Yes, they're trying to tackle it from both the ends, from the supply end, and clearly it's a heavily oversupplied market, and from the consumer end as well, trying to stimulate the consumers. So on the consumer end, we hear they're reducing the down payment from 20% to 15%. You know, big deal, I would say. But I'll get to that in a moment. I think they're removing the floor from mortgage rates. So, you know, things like that to try and get the consumers a little more excited about buying property. And on the supply end, the state-owned enterprises are being given tens of billions of dollars from the central government so that they buy up these unsold properties and maybe, you know, convert them into affordable housing or something. You know, it just sounds like, so in some ways, you know, money from one pocket to another, but also in an increase in debt. And, you know, that problem of increasing debt at the local government level as well is sort of being pushed to one side. But at the end of the day, you know, being able to do 15% down payment instead of 20%, is that going to excite Chinese consumers? I really have my doubt, because consumer confidence, not just, and of course, what property sector is doing is a big component of that, but consumer confidence in general, what we're hearing is pretty low in China. So, you know, I don't really see the consumers jumping in for the property market. All said and done, we'll probably see some impact on this, but, you know, I wouldn't hold my breath for a very quick recovery, very, very slow. So where all of that ties in, of course, is to oil demand, because, you know, gas oil demand has been quite sluggish in China, partly because of the property sector. And, you know, I don't see that sort of jumping up anytime soon. So very, very slow impact is what I haven't revised any of these measures that we've seen from the Chinese government, and including some of the more supportive Q1 data, Jan to April data. My expectations are still for about maybe 400,000 to a little bit more barrels per day year-on-year growth in Chinese demand, which would be about half of what happened, what was the growth last year. So in effect, the post-COVID, the bulk of the post-COVID recovery rebound in Chinese demand happened in 2023, in my view. And from here, it just sort of, you know, peters out a little bit.
Gaurav, last word for you on that. I mean, again, on the OPEC sort of being on the horizon here, OPEC Plus, and trying to read their tea leaves as to where they go from here. You know, one of the question marks they'll be looking at, and obviously China demand and the outlook for China demand, but the other is, you know, we've got half the growth of Asian growth, demand growth this year, but we also seem to have half the growth in new supply from the Americas. Your thoughts on where we might see the Americas, the US shale in particular, but also Guyana elsewhere? Could we see more supply coming back from, or more supply, new supply coming from the Americas that will spoil OPEC's party a little bit in the second half and need them to keep their cuts firmly in place?
Well, I'm firmly of that camp, you know, in that camp. I think what I would say is we should not ignore Brazil and Canada as well. So if you look at the Americas, take more holistically speaking, it's not just about the shale gale or shale bonanza, how you might want to choose to describe it. So I suspect that much of the demand increments, especially for light sweet, can really be serviced by the Americans alone. So yes, OPEC will face this quandary. I think it's a done deal what they might do. I mean, there's always the 1% element of surprise, but it's pretty much a done deal what they're going to do. In terms of demand, China is not what it used to be. No matter how much you say that it's come back from a bit of a historic base, but there was a COVID lull as well. Chinese demand is not what it used to be. We're still in the analyst community waiting for some data, additional data, see how May pans out, see what the reading of the second reading of the Q1 US GDP is. But yes, there are complexities on the horizon. So we're sort of stuck in where we are for the next 2 months. That's how I would put it.
Yeah, it does. And I think in the bigger narrative, and Adi said it, I think maybe before we came on air or not, but that this overall demand growth narrative everybody wants to be quite bullish. And here at MPGC this week, the continued narrative from the oil industry that demand growth, everybody more or less dismissing the IEA forecast that 2030 is a peak. But clearly from the China point of view, coming out of COVID, I mean, it does feel very much like we're in at least from a China point of view, emerging or getting in the zone of peak oil demand in China, thereabouts, give or take. And I think that narrative is going to sort of bed in firmly into the OPEC psyche as to where that influences their decisions going forward. We'll have to leave it there. Brent trading down this morning in Asia about 0.5%, sort of stuck in that doldrums of no real direction, $82 to $84 holding there. I think ultimately everybody should be and is pretty happy with that, at least from a producer-consumer point of view. We'll wait and see whether the OPEC decision, when it finally lands, yes, we're going to roll over our cuts for 6 months or 3 months, does that create a wind in the sails of this market, or is that already priced in? And we'll see where that goes, but that could come. The rollover of the unilateral cuts, that decision, that announcement could come any day. Adi Imsirovic, thank you so much from the UK. Vandana Hari, of course, as always, from Singapore, but it looks like you're showing a different flag at the moment today. And
I'm in Western
Gaurav,
Australia.
Western Australia. My goodness, that sounds nice. Gaurav Sharma in Western, I don't know. London or London, yes. Well, no, that's a lovely spot too, Kensington and all those nice places. So enjoy, take care, everybody. Look forward to talking to you all soon again. Thank you so much for joining us on the Daily Energy Markets podcast today from MPGC in Dubai. All the best.
All the best.
Thank you. Bye-bye.
Bye.